Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and 10-year note yields still in that range, that 280 to 290 range. We tried our hardest to break out of it. We did not. We're going to settle this week right in the middle, 285. Recall that was the level we'd settled for like 6 out of 7 straight Fridays to end the week, and we're right back there again. It's the 30-day moving average. It's kind of setting us up for the coiling of the spring, waiting for that it moment. And FOMC next week could be that moment. The market right now awaiting FOMC. It has been for a long time, and that is going to be what really moves us out of this range, at least hopefully it will. Market volatility, yeah, it's a little bit higher ahead of an event that's usually pretty typical, but in recent, call it the last year and a half, it hasn't really been the norm. So right now, seeing a bit of volatility suggests to us that two things. One, that the trade towards 3% might not be as guaranteed as we thought. And secondly, we can clearly see where the trade of pain is in Treasury land. Treasuries are seeing the trade of pain towards lower yields and higher prices. We remain at record or near record short positions from the hedge fund community. That is where you're going to start to see trade of pain if we start to move back towards 2 3/4, 275. That is the level you do not want to see if you are short the market, because you're going to probably start to get squeezed, or if you hadn't already gotten squeezed out. That could be what causes the level, and if you causes the squeeze. And lastly, let's look at FOMC next week. We have our Fed chair, Chairman Powell, looking at his first meeting at the big table with the gavel in his hand. That will be key. Obviously, they're expected to raise 25 basis points. It's been that way for quite some time. That is not a surprise. Here's where it gets interesting, though. We look at forward guidance and we look at the press conference, and with GDP numbers being marked lower, I think today we had the GDP now number come in at 1.8. That was at 5.4 about a month ago. Likewise, we've had weaker housing numbers. We've had a mix in sentiment, and I think that right now the inflation numbers, while they're still higher, they're not in a level that would cause the Fed any sort of angst. So we're seeing modest inflation with lower growth projections, and that is going to be something that the Fed chairman is going to have to explain, at least how they're going to move around that or navigate that, with 3 rate hikes on the table, at least priced into the market, with the fourth that was hopeful. Now, if you take that fourth off the table, I don't think it changes much. But if you take the third, at least part of the third off the table, that will change a lot. And so the Fed chairman really wants to keep things calm, really wants to keep things steady. His gradual movement towards higher rates is certainly where he wants to keep the market focused, doesn't want to take away any rate hikes that are already priced in. So it'll be very interesting to see how he does that. Likewise, with the Treasury curve getting back to those decade-low flat levels, can the chairman avoid, saying something about that? I doubt it. So I think he's going to have to face Treasury curve questions. He's going to have to face outlook questions, GDP questions. There's a lot of things he's going to have to face in that press conference, which won't be on the piece of paper that they submit at the end of the day. So right now, I think that this could be a turning point, at least for now, for the Treasury market to break out of that range. We're talking that 280 to 290 yield range that we've been sort of stuck in on a settlement basis for some time. This could be the week after FOMC. This is Todd Colvin coming to you from the floor of the CME Group.